Hello everyone, and welcome to Financial Accounting with Anne-Marie Anderson. Today we will be learning to calculate depreciation using the double declining balance or DDB method. If you're still unclear on what depreciation even is, I'd suggest you watch the depreciation overview video first. Okay, let's get into it. The double declining balance method is an accelerated depreciation technique that calculates depreciation by applying twice the straight line rate to an asset's book value at the beginning of each period, resulting in higher expenses early in the useful life. Let's take a look at Manny, who just bought a delivery van for his business. It cost $46,000. He estimates that he will be able to drive the van for 5 years before disposing of it. He anticipates that he will be able to sell it for $6,000 at the end of those 5 years. This is the residual value. The journal entry is a debit to delivery van and a credit to cash for $46,000. Our ledger account, or T account, would have an asset of $46,000 recorded, which is called the book value. Since we just purchased it, there wouldn't be any accumulated depreciation just yet. Here's the formula for DDB. Take the book value of the asset times 2 times the straight line rate. Some people say that DDB is like straight line times 2 because of this formula, and that's partially correct. We'll get into that in a minute. There's a quick shortcut to this formula, which is multiplying the book value times 2 over the useful life. So that makes it $46,000 times 2/5, which is $18,400 in depreciation. You might notice that we aren't talking about residual value. We'll deal with that later. The journal entry for depreciation is always the same, with a debit to depreciation expense and a credit to accumulated depreciation. And for year 1, we have just calculated the amount to be $18,400. This may be easier to visualize in T accounts. You have the value of the van at $46,000, which is untouched per the cost principle. The accumulated depreciation van account now has an $18,400 credit balance. So when we net the two accounts together, the current book value of the asset is $27,600 after the first year. Let's look back at our formula for a second. Note that we start each calculation with the book value, which means for year 2, it will be $27,600 times 2/5, which is $11,040 in depreciation for year 2. After we prepare our depreciation entry for the year, you can see that accumulated depreciation is now $29,440, making the book value $16,560 at the end of year 2. Before moving into our third year calculation, let's look at this information a little differently. Year 1 and 2 we just completed, multiplying the current book value by the DDB rate to come up with the depreciation for the year. So now let's move on to year 3. Taking the current book value and multiplying by 2/5 is $6,624. Once we update the $6,624 in our T account, you can see the book value at the end of year 3 is $9,936. Year 4. We prepare the same calculation, $9,936 times 2/5, which is $3,974.40, and we update our T account for the year 4 depreciation. That brings us to a book value of $5,961.60. Oh no, that can't be right. Let me show you why. Assets are not depreciated beyond the residual value, and our residual value is $6,000. With DDB, we need to do something a little special in the final year. We calculate what the last year needs to be to get us to $40,000 in accumulated depreciation so that when it nets with the asset, we are left with a $6,000 book value. That $3,936 is better known as a plug. So in that final year, we don't use the DDB rate at all. Rather, we simply plug that last number. Okay, so a pro of the DDB method, it records higher depreciation early on, matching expenses with an asset's faster loss of value. This makes sense because logically an asset loses most of its value in the early years of use. But on the con side, this is time consuming and more calculations are required than they are for other methods. Let's leave off with a fun fact. The IRS actually uses DDB with a little bit of variation. They call it MACRS, the Modified Accelerated Cost Recovery System, but it's basically DDB. That wraps up double declining balance depreciation. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.